Here's the midterm review for chapters 1 through 9. And we're going to start with chapter 2. You will not have anything on the midterm from chapter 1. So chapter 2, basically what you'll need to do for the midterm is to remember your journal entries that we went over. Okay, so the first one says, Bergman contributed $60,000 in cash and equipment worth $90,000 to open a landscaping business. So Bergman is starting a landscaping business and investing money and equipment into the company. Debit cash $60,000 to recognize the $60,000 cash that he's investing. Debit equipment to get the equipment on the books at $90,000. Then you will credit Bergman, capital for $150,000 to give him credit for the $150,000 contribution that he made. The second one, Bergman provides lawn services for local residents. One customer paid Bergman $4,000 for 4 months service in advance. So Bergman has not performed the lawn or the landscaping services yet. So this cannot be considered revenue yet for him. It is put into a liability account called unearned revenue, and therefore waiting for Bergman to actually perform the services and recognize it as revenue. He did receive the money, so he'll debit cash $4,000 and then credit unearned revenue $4,000. Number 3. Bergman billed a client $750 for work performed in the current month. He performed the service, but he's billing his client because he has not received the money. Debit accounts receivable $750, and it will sit there until the client pays, and then credit revenue. With accrual accounting, you recognize revenue when earned, not when received. Number 4, Bergman collected the $750 from their client. Debit cash $750 because the client gave him the money, and then credit accounts receivable to reduce what he owes. We put it into accounts receivable at $750. Now that the client paid, we take it out of accounts receivable at $750. So it shows a zero balance. Okay, the next one. Bergman purchases $500 of supplies and pays cash immediately. So he purchased supplies for cash. He now has the supplies that he didn't have before, so debit supplies $500. And then credit cash $500 because he paid cash for it. Bergman received a $200 utility bill for the current month's electricity. It is not due until the end of next month, and that is when he will pay it. Remember, you have to recognize the revenue when earned, not when received. Same thing with the expenses. You need to recognize the expenses when incurred, not when paid. It is for this month's current utility bill, so we'll debit utility expense and recognize these expense in the period that it incurred, and then credit accounts payable $200, and it will sit there. It's a liability account until you paid at the end of the month. In chapter 2, we also went over some ratios, and we'll revisit them when we get to chapter 17. And the one I wanted to concentrate on for the midterm was the debt ratio. Debt ratio is total liabilities over total assets. And the total liabilities is $190,000. The total assets is $350,000. In this problem, they also give you the equity. Just remember that they're going to give you more information in the problem that you need. They want you to pull out the information that you need and know what to do. Okay, so when you divide these two numbers, you get a debt ratio of 0.54. That means they owe more money than what they have assets for. 54% of what they earn goes directly to the bills that they have. Okay, that's it for chapter 2. Now we're going to go on to chapter 3. Bergman paid $2,400 cash for management services to be performed over a 2-year period. Bergman follows a policy of recording all prepaid expenses to asset accounts at the time of cash payment. He will debit prepaid management services $2,400 because it's an asset, and credit cash $2,400 because he paid for it. Okay, the next one takes a look at what happens at the end of the year when part of that management service has been used. It says, what would be the expense on the annual income statement for the first year ended December 31st? Okay, well, this was for a 2-year period, and now the first year is done. So we have to expense out half of that amount because half went to year 1 and the other half went to year 2. Half of $2,400 is $1,200. Debit management services expense $1,200 to recognize the expense for that year, and then credit the prepaid management services $1,200 because the full $2,400 is not prepaid anymore. Okay, the next question. Prior to recording adjusting entries, the office supplies account had a $400 debit balance. A physical account of the supplies showed $150 of supplies available. So they had $400 in there, but what's actually in the supply closet is only $150. So take the difference between what the accounting books say and what the actual count is, and that tells you how much has been used. Debit office supplies expense the $250 to recognize the portion of the office supplies that have been used, and credit office supplies. Okay, this next one is on payroll, and it can be a little tricky. Bergman pays each of its 2 employees each Friday at a rate of $200 each day for a 5-day work week, which is Monday through Friday. If the month ends on Wednesday and the employees worked all the days that week, Monday, Tuesday, and Wednesday, what is the adjusting entry that's needed at the end of the month? Okay, what's happening here is they get paid on Friday. Friday's the day that the journal entry is done. But you also have to take into account the adjusting entries that you make at the end of the month. So here we have this 3-day work week that we have to recognize by the end of the month, even though we are not paying it until Friday, 2 days later in the next month. Okay, so let's calculate how much the employees have earned. They worked 3 days and they earned $200 a day. So that's $600 per employee. There's 2 employees, so multiply that by 2. So it's $1,200 worth of work employees have done. And we need to expense that out because it happened in that current month. We will debit salaries and wages expense $1,200 and credit salaries and wages payable $200. That's the adjusting entry. Now let's look at what the journal entry is going to be on payday. On payday, it's going to be Friday, 2 days later. So they have 2 more days that work week that they need to recognize. It's $200 a day, and it's 2 days, so it's $400 each employee has earned. But there's 2, so take that and multiply 400 by 2, and that's $800. So we still have $800 more that we need to recognize. Debit salaries and wages expense the $800. And then we will also debit salaries and wages payable. In the initial transaction, we credited salaries and wages payable, but now that we're actually paying the employees, we want to zero that out because we don't owe it anymore. And then, of course, credit cash the $2,000, which is $200 a day times 5 days times 2 employees. Okay, the next one. On January 1st, Bergman receives $6,000 from its customers for summer service special in advance, and it recorded it as unearned fees. The summer was May through August, which is 4 months long, and the revenue is to be spread evenly throughout the months. What is the amount of service revenue that Bergman should recognize on July 31st? Okay, so the summer month special is May, June, July, and August. May has happened, June has happened, and now July has happened. 3 of the 4 months. If you take the $6,000 and you divide it by the 4 months, then you should actually recognize $1,500 per month. You're recognizing the first 3 months, May through July. Take the $1,500 times the 3, that's $4,500. We need to recognize $4,500 of that unearned revenue that is now earned. Okay, move on to Chapter 4. Chapter 4. The owner of Bergman's Lawns to Go is the name of his company, withdrew $7,000 from the business during the current year. What is the journal entry to close out the withdrawal account? Okay, Chapter 4 is all about closing out the books. We learned about the worksheet and how that aids in the preparation of the financial statements. We learned about the financial statements, and then we also learned the 4 closing entries. Closing the withdrawal account is the 3rd closing entry out of the 4. Withdrawal account has a normal debit balance. And in order to close it out, we need to credit that account. The withdrawal account gets closed out into the capital account. So we'll debit Bergman Capital $7,000 and credit Bergman Withdrawals $7,000. Okay. In this problem, we're closing out the income summary account. So Bergman had annual revenues of $170,000, expenses of $98,000, and he withdrew $7,000 from the business during the current year. The owner's capital account before closing had a balance of $220,000. And we need to figure out the entry to close the income summary at the end of the year after the revenue and expenses have been closed. So the first journal entry is to close out your revenue. Second journal entry is to close out your expenses. Both of those to close out into income summary. So I made some T accounts here to explain the process. Okay, when we close out the revenues of $170,000, we're going to debit the revenue account to zero it out and credit income summary. Then the expenses are $98,000. Expenses hold a debit balance, so to zero them out, we will credit all of the expenses, which means we will debit income summary. What's sitting in income summary at this point is $72,000. And income summary now is going to be closed out into the capital account. Income summary has a credit balance of $72,000, so to close it out, we debit the income summary $72,000. So I drew a big box here around that. The capital account had a balance already of $220,000. The journal entry to close out income summary is to debit income summary $72,000 and credit capital $72,000. So here is the debit of income summary, and then here's the credit of the capital account. Okay, that's it for the question. But since they did give you the information for the withdrawal, let's go ahead and just practice that. You would credit the withdrawals and debit capital. Okay, the next one also practices the closing entries. It says after closing entries, what will be the balance in the capital account? Okay, so I have a T account for the capital account in it. and the capital account had $79,000 in it. Then you close out your revenue, which is the $310,000. That will be a debit to the revenue account and credit to capital. Then you close out your expenses. Expenses have a debit balance, so you will credit the expenses and you will debit the capital account, $67,000. And then don't forget the withdrawals. The withdrawals have a debit balance, so to close them out, you credit withdrawals $7,000 and debit the capital account $7,000. The new balance of your capital account after your closing entries is $315,000. Okay, this is the last one for chapter 4. We don't deal with net losses a whole lot in this class, but let's practice what it would look like if we did have one. What is the closing, after the closing entries, what is the balance of the capital account? Same as before, but this time we're looking at a net loss. Okay, the capital account has a credit balance of $125,000. And then the withdrawals were closed, which means we will credit withdrawals, debit the capital account, $15,000. A net loss. A net loss is going to decrease capital because capital needs to be used to make up for the fact that they lost money. If it was a net income, then you would be crediting the capital account to increase it. Since it is a net loss, you're going to be debiting the capital account to decrease it. That's why we have a debit of $23,000 here for the net loss. Then the new balance in the capital account is $87,000. Okay, moving right along, chapter 5. The company has sales of $391,200 and its gross profit is $164,700. What is the cost of goods sold? Okay, so if you take your sales, you subtract your cost of goods sold, that gives you your gross profit. Cost of goods sold is what we don't know. We know our sales and we know our gross profit. Subtract the two and that will give you your cost of goods sold. Okay, let's look at another ratio. Let's look at the quick ratio. The quick ratio is quick assets over current liabilities. Now again, they're going to give you more information in there than what you need. So what you need to do is figure out which information you need and which ones you don't. You're given your current assets and your quick assets. Well, because we're looking at the quick ratio, you don't want your current assets, you want your quick assets, which is basically cash, cash equivalents, and inventory. Or minus inventory. Okay, and then you're given your current liabilities. Quick assets was $13,620 divided by your current liabilities of $13,900, and once you round to 2 decimal places, you get 0.98. And what the quick ratio tells us with this answer of 0.98, that means for every dollar that you owe, you have 98 cents to pay. Okay, the next question. Bergman purchased $2,300 of merchandise on July 1st with terms 110 net 30. So this is saying that if they pay within 10 days, they get a 1% discount. If not, the net is due in 30 days. On July 7th, they returned $250 worth of merchandise. And then on the 8th, they paid the full amount. What is the amount of cash paid on the 8th? Okay, so let's look at this. They purchased $2,300 and then they returned $250, which means technically the balance that they owe is $2,050. But they are paying 3 days later, and that is well within that 10-day discount, so they get to take a 1% discount. 1% of $2,050 is $20.50. Subtract that $20.50 from the $2,050, and that will give you the amount of cash that they're going to pay. $1,029.50. Okay, this next one is still on the review template, but we're going to skip this one. So on to the next one. Bergman had sales of $151,000, sales discounts of $2,250, and then sales returns of $3,625. What is Bergman's net sales? How you calculate your net sales is taking your sales, subtracting the sales discounts, and subtracting the sales returns. That will give you your net sales of $145,125. On February 3rd, Bergman sold merchandise in the amount of $4,300 to a customer with credit terms 310 net 30, which you know is a 3% discount if they pay within 10 days. If not, the net is due in 30 days. The cost of the item sold is $2,970. Bergman uses a perpetual inventory system and the gross method. The customer pays the invoice on February 8th and takes the appropriate discount. What is the journal entry to record the payment? Okay. They sold merchandise for $4,300, and the customer will get a 3% discount if they pay within the time frame, and they're paying 5 days later. That's well within the 10 days. Take 3% of the $4,300, that's $129. Subtract the $129 from the $4,300, and that's $4,171. That is the amount that the customer is going to actually give us. So we debit cash, the $4,171, debit sales discounts, the $129, and then credit accounts receivable, the full $4,300. Bergman had $818,000 in sales discounts of $12,270, sales returns and allowances of $18,405, cost of goods sold of $388,550, and $281,395 in operating expenses. What is the net income? Okay, let's calculate the net sales first. Take the sales, subtract sales discounts, and subtract sales returns and allowances, and we get net sales of $787,325. From there, subtract cost of goods sold, and that gives you your gross margin, and then subtract operating expenses, and that gives you your net income. The net income is $117,380. Okay, the last question in Chapter 5 is to calculate the inventory turnover. We're given the cost of goods sold, the ending inventory, and the average inventory. You need to remember that the formula for the inventory turnover ratio is cost of goods sold divided by average inventory, not just ending inventory. They want to take the average of the inventory, which means you take what you start the month off with, add what you ended the month off with, and divide by 2 to get the average. So do not use the ending inventory, use the average inventory. Okay, so take the cost of goods sold divided by the average inventory, and you get 4.44. They turn over their inventory an average of a little over 4 times a year, or 4 times. Okay, Chapter 6. Chapter 6 is on ending inventory methods. So here we're looking at specific ID. We're given the information for all of the purchases and up top here in the table. And then down here we're told that there are 41 units remaining in ending inventory. We just need to figure out what those are. And they tell us that the 41 units consists of 5 from January, So I have 5. In January was purchased at $123. So 5 at $123. And then 7 from February. 7 at the February price of $133. 9 from May. May was at $143, so 9 times $143. 7 were from September, 7 at $153. And then 13 were from November, 13 at $163. Add all of multiply those and then add them up, and you get $6,023 is your ending inventory using the specific ID method. We're going to also skip that one. I didn't write it on there, but skip that one. Okay. Okay, this is the Lifo method. We're given the beginning inventory of June 1st of 44 units at $20. And we need to calculate the ending inventory. On June 15th, we purchased 36 units for $50. So when we sold, we sold 36 at $50. We had 44 on hand. We sold 36, so now we have 8 left. Those 8 that we have left are all in there at $20. Then we purchased 36 at $25. So what we have then at the end of the month is we have our original 8 at $20, which is $160. And then we have the 36 that we just purchased all at $25, and that's $900. Our ending inventory using Lifo for this example is $1,060. And then here's one more turnover ratio, but this time you have to actually calculate what the average inventory is. We know that the inventory turnover ratio is cost of goods sold divided by average inventory. Cost of goods sold right here for year 2 is $388.6. And then to get the average inventory, take year 1 plus year 2 and divide it by 2, and then you get 4.94. Let's also calculate the days sales uncollected. And that is ending accounts receivable divided by net sales times 365. Ending accounts receivables, it says ending accounts receivables 3,100. And then net sales was 31,100. Divide that and then multiply by 365. You get 36.38 days. This is how many days are uncollected. So if the credit time period was 30 days, that is what your customers have to pay, and you're at 36 days, that means your customers are not paying on time. And you need to check with the credit department and have them call the customers and try to get payment. Okay, we are almost done. Okay, chapter 8. At the end of the day, the cash register tape shows $1,040 in cash sales, but the count of cash in the register was $1,060. What is the proper entry to record to account for this excess? Okay, you need to debit cash, what you actually deposit, which is the amount that you have, $1,060. You'll credit sales of $1,040 because that's what sales were. Okay, that $20 extra that you have will be a credit into the account cash over short. Assume that the custodian had custodian of a $750 petty cash fund has $162.50 in coins and currency, plus $562.50 in receipts at the end of the month. What is the entry to replenish the petty cash fund? Okay. We have the $750 that we started the month off with. And then if you subtract the cash you have, the coins and currency, and then subtract all of the receipts you have, you end up with a $25 shortage. Take the amount of the receipts plus the shortage, and that gives you $587.50. That is the cash amount that you need to reimburse. You will debit the expense accounts, whatever they are, and credit cash $587.50 and go down to the bank and get $587.50 to replenish the cash fund. Okay, one more on petty cash. Childers Company, which uses a perpetual inventory system, has an established petty cash fund in the amount of $500. The fund was reimbursed on November 30th, and now it's the end of December, and this is what we have. We have 4 separate receipts in there. We have one for $60, which is freight charge. We have $84 of delivery. We have $49 of office supplies and $68 of charity. If in addition to these 4 receipts, which add up to $261, the cash fund contains $231. Okay, what's the journal entry? So between cash and your receipts, we should have $500. So over here, I wrote down that we have cash of $231. We have receipts of $261. That is only $492. We are short $8. We need $8 more to get back to our $500. So we're going to have to use our cash over and short account for $8. The freight charge for merchandise purchase is going into inventory because we paid $60 in freight, so we need to add that $60 to the cost of our inventory. Delivery charge I put into shipping expense for $84, office supplies for $49, and then donation expense for $68. Then don't forget what you're short, the $8. You want to debit cash over and short $8 for a total of, for cash to credit, $269, and that will take you back up to the $500 to start off January. Okay, on to 2 bank reconciliations, and then we'll go on to our last chapter, which is chapter 9. We need to calculate the adjusted cash balance per the books. The cash balance is the book balance. That's what we have, not the bank balance. So you write in book balance, and the book balance was $62.40. It says right here the cash balance on April 30th was $6,240. And then we want to add and we want to deduct. What we're going to add is we're going to add the note collected. It said note received and interest calculated, and that on Donahue's behalf, that's $700. This is $700 the bank knew about, but we did not know. So we need to add it to our book balance. And then we have 2 things we need to deduct. On our bank statement showed that we had an $80 charge for ordering checks. And then we also had an NSF check for $550. We did not know that the customer's check bounced. Subtract the 80 and the 550 from the 6940, and we get an adjusted book balance of $6,310. Okay, this time on the bank reconciliation, I did both sides. I did the bank balance and I did the book balance. It tells us that the cash shows a balance of $21,662, and I put that right here for the book balance. And then the bank statement shows $21,037. I put that there on the bank balance side. And then I put the add and deduct for the book, and the add and the bank, and then the add and deduct from the book. Okay, deposit in transit, we already know about, but the bank doesn't, so we need to add that deposit to the bank side. And then we get a subtotal. Outstanding checks are checks that we have written, but the people we wrote them to have not cashed them yet. And since they have not cashed them yet, the bank does not know about them yet. So we need to subtract the outstanding checks from the bank side. Then after we do that, we get an adjusted bank balance of $22,487. Okay, now on to the book side. The bank collected a note on our behalf, so we need to add that of $960. And then we had a bank service fees of $135. We need to subtract that. We also get an adjusted book balance of $22,487. You want the bank side and the book side adjusted balances to balance. Okay, let's do the last chapter, chapter 9, which was on receivables. We're looking here at a company that received a 10% 90-day note for $3,300. And we need to calculate the interest that is going to be due on the maturity date. Make sure you use a calendar year of 360, not 365. Whenever you're dealing with the bank, a banker's year is 360. Okay, I use the formula I equals PRT. Interest equals principal times rate times time. Principal is the amount of the note, which is $3,300, times the rate of 10%, times the time, 90 days over 360. When you multiply those, you get interest is $82.50. Okay, and then the next one is exactly the same thing, but this time it's just a promissory note, but it works the same way. I equals PRT. The principal is $18,000. The interest rate is 11%. The time, it's $120 promissory note. 120 divided by 360. You get $660 for the interest for this promissory 120-day note. Okay, let's look at a couple journal entries. Gideon Company uses the allowance method of accounting for uncollectible accounts. On May 3rd, the Gideon Company wrote off the $2,600 uncollectible. What is the journal entry for this write-off? When you're using the direct write-off method, you debit bad debt expense and you credit the accounts receivable for that one customer. Now this is the allowance method, and with the allowance method, instead we debit allowance for doubtful accounts, and then we still credit the accounts receivable for that customer. Okay, Jasper makes a $84,000 90-day 7% cash loan to Claiborne Company. What is the journal entry? You debit note receivable, the $84,000, to recognize that now Claiborne owes you the money, and you open up a receivable for them. And then you credit cash $84,000 because you gave them, it was a cash loan, you gave them $84,000. Okay, Jasper makes a $27,000 90-day 8% cash loan note. Record the collection of the note and the interest at maturity. Okay, the first thing we need to do is we need to calculate how much interest there will be. We use I equals PRT. Take the $27,000, multiply by 8%, and then multiply by 90 over 360. The interest is $540. So what we're going to, or what Jasper is going to get on the maturity date is the $27,000 of the note plus $540 of interest. So they'll write a check to the company, and so we will debit cash $27,540. Note receivable was originally debited for $27,000, so we will credit note receivable for $27,000 to zero that out since they're paying it, and then we'll recognize interest revenue of the $540. Valley Spa purchased $8,000 in plumbing components from Tubman Company Valley Spa. They signed a 60-day 12% promissory note for $8,000. If the note is dishonored, but Tubman intends to continue collection efforts, was the journal entry to record this dishonored note. When you have a note that is dishonored, you close out the note and open up an accounts receivable account that includes the interest. So in this one, we debit accounts receivable $8,160. The $8,000 of the note and then the $160 of the interest. They're going to collect the amount of the note plus the interest. Then they'll recognize the interest revenue that they've earned even though they haven't received it of $160, and then credit notes receivable to take it out because they've changed note receivables and they've made it an accounts receivable, and then they're going to continue their efforts to try to collect. And then finally the last one for the midterm review. Craigmont uses the allowance method to account for uncollectible accounts. Its year-end adjusted trial balance shows accounts receivable of $154,500. Allowance for doubtful accounts is $1,165 credit balance, and I wrote that right here in the T account. And then sales of $1,175,000. If uncollectible accounts are estimated to be 4% of accounts receivable, what is the amount of bad debt expense in the adjusting entry? So we're looking for 4% of accounts receivable. Accounts receivable balance is $154,500. Take 4% of that. That's $6,180. That is the amount that we want in the allowance account. It is currently $1,165. We want it to show $6,180 to account for 4% of this period's accounts receivable. Take what you want it to be and subtract what it currently is, and that tells you the amount of the journal entry, and that's $5,015. Debit bad debt expense to recognize it, and then credit the allowance account, $5,015. Okay, you will have 41 questions on the midterm, and here's an example of each question you have on the midterm. If you have any questions, please don't hesitate to give me a call, and I'm here to help. Thank you.